Okay, think about Isaac Newton for a second. Like, the Isaac Newton, genius, right? Calculus, gravity, all that.
A towering figure of rational thought, absolutely.
Yet even he got sucked into the South Sea bubble, made some money, got out, then apparently jumped back in near the peak and lost a bundle.
Ouch. Yeah.
His famous quote afterwards was something like, "I can calculate the motions of heavenly bodies, but not the madness of people."
A very humbling lesson, especially from him. It's a stark reminder, isn't it, about market psychology.
Totally. And that really sets the stage. Welcome, everyone, to Book Talk Finance.
Glad to be diving in.
So this book talk is part of our channel, The Deep Dive. And what we try to do here is basically unpack the big ideas from important finance books, make them accessible for you, without getting bogged down in overly technical stuff.
Getting straight to the core insights.
Exactly. And today we're tackling a real classic, A Random Walk Down Wall Street by Burton Malkiel. It's kind of a guided tour through investing essentials.
Yeah, Malkiel is a very well-respected economist, and the book gives this fantastic critical look at how markets work and, well, some really timeless advice on investment strategies. Very readable, too.
Definitely. Okay, so let's jump right in. One of the first things Malkiel really tackles is this common idea, this feeling maybe, that individual investors like us are kind of playing a rigged game against the Wall Street pros.
Right, the idea that the big firms with their fancy algorithms and, armies of analysts have this inherent edge, it feels intuitive.
It does, but Malkiel pushes back on that. He actually points to history.
Uh-huh.
Like, think about the aftermath of the '87 crash. He suggests that many regular investors who just sort of held steady, didn't panic, actually ended up doing better than some professionals who were furiously trading.
Yeah, trying to time the market, using complex strategies that maybe didn't pan out. We saw similar things with derivatives in the 90s, too. Complexity isn't always the answer.
It's not. And this whole discussion really brings up a fundamental question, doesn't it? How do we even figure out what a stock is actually worth?
Exactly. And that's where Malkiel introduces these two sort of competing theories of stock valuation. They offer really different ways to look at prices.
Okay, what are they?
Well, first you have the firm foundation theory.
Firm foundation sounds solid.
It does. The idea here is that every stock has this intrinsic value, a real value based on the company's underlying reality, specifically the present value of all the cash flow it's expected to generate for shareholders in the future, mainly dividends.
Okay, so looking at the business itself, its health, its future prospects. Malky mentions John B. Williams and his book, The Theory of Investment Value, right? Especially this idea of discounting. Can you unpack that a bit?
Sure. Williams's big contribution was formalizing this idea that, a dollar you get next year isn't worth the same as a dollar in your hand today, because you could invest today's dollar and earn interest.
Right, the time value of money.
Exactly. So discounting is just the math you do to figure out what that future stream of expected dividends is worth right now in today's dollars. You discount those future payments back to the present.
Got it. So a company paying good dividends now and expected to grow those dividends steadily. Well, under this theory, its stock should be worth more.
Precisely. The growth rate of those dividends and how long you think that growth can last are absolutely key. But, and this is a big but Malkiel points out, predicting that future growth accurately, that's the really hard part. Sometimes the market seems to price stocks as if that growth will go on forever, which is, well, unrealistic.
Yeah, sounds like a major challenge. But this fundamental approach, it's had a huge impact, hasn't it?
Oh, definitely. Malkiel talks about Graham and Dogg's security analysis, kind of the Bible for generations of Wall Street analysts. Their whole focus was finding companies trading below that calculated intrinsic value.
Looking for bargains based on fundamentals.
Exactly. Buying a dollar's worth of assets for 50 cents, basically. And, Malkiel highlights Warren Buffett as probably the most famous and successful disciple of this whole Graham and Dodd firm foundation approach.
The ultimate value investor, yeah. Okay, so that's the solid, rational, firm foundation view. What's the other one? The castle in the air theory. Sounds less grounded.
It is. This theory suggests that stock prices are driven much more by psychology, by what investors believe other investors will pay for a stock in the future. It's not about intrinsic value. It's about guessing the crowd's mood.
Ah, okay. So it's like you're trying to build a castle in the air, hoping someone else will come along and pay you even more for it, even if it's built on, well, air.
That's the metaphor, yeah. It's about riding the wave of optimism or avoiding the crash of pessimism. It focuses on investor sentiment and speculation.
And Malkiel uses some pretty wild historical examples to illustrate this, starting way back with Tulip Mania in Holland. I mean, trading houses for flowers.
It sounds insane, right? Between 1634 and 1637, prices for some rare tulip bulbs just went parabolic.
Hmm.
People were bartering land, livestock, their life savings for a single bulb.
Unbelievable. What's the takeaway for us from that?
The core lesson is just how detached prices can become from any underlying reality when hype takes over. People weren't buying bulbs to plant. They were buying them because they thought someone else, a greater fool, would pay even more tomorrow.
Yeah.
Even though some argue the initial prices had some basis in rarity, that final spike and crash in 1637 was pure speculation and panic.
A classic bubble. Okay, fast forward a bit. The South Sea Bubble, 1720. What happened there?
Similar story, different asset. The South Sea Company was granted a monopoly on trade with South America, even though it had, like, zero experience.
Sounds promising.
Well, the story was promising. Public enthusiasm went wild, the stock price soared, insiders made a killing early on.
Of course.
But the whole thing was built on unrealistic expectations. When it became clear the promised riches weren't materializing and insiders started selling, the bubble burst. Huge losses for the public. And that's where Newton famously lost his money the second time around.
Right, back to Newton. It really drives home the madness of people point. So these historical examples show prices getting way out of whack with fundamentals. What about closer to modern times, like the 1920s before the 29 crash?
The Roaring Twenties. Malkiel points to things like pools, groups of traders who deliberately manipulate a stock's price, buying and selling amongst themselves to create the illusion of high demand and suck others in.
Sketchy.
Very. And you had this incredible optimism. People like the famous economist Irving Fisher were saying stocks had reached a permanently high plateau literally weeks before the crash.
Wow, bad timing.
Understatement. The lesson there is that widespread bullishness doesn't mean the market can't crash. And when it did crash in October 29, the panic was amplified because the ticker tape showing prices fell hours behind the actual trading. Imagine the fear.
Chaos. Malkiel also talks about the market for new issues, right? And concept stock, things that sound exciting but maybe don't have much substance yet.
Yet the appeal of the next big thing. He notes how often investors ignore the warnings, right there in the prospectus, during boom times. They buy the story, not necessarily the business.
Like the conglomerate craze in the 60s?
Exactly. Companies were just merging like crazy, often creating complexity rather than real value, just to show growth on paper. Malkiel gives examples of convoluted accounting and jargon used to hype these things up. Eventually, the market saw through it.
So hype over substance again. Then came the Nifty 50. That sounds different. These were good companies, weren't they?
They were. Mostly large, stable, blue-chip companies with strong growth records. Think Kodak, IBM, Xerox back then. The problem wasn't the companies. It was the price people paid for their stocks.
Ah.
Investors decided these were one decision. Stocks, buy them and hold forever. Price doesn't matter because their growth was supposedly guaranteed. So their PE ratios went sky high.
And even great companies can become overvalued.
Precisely. Eventually, their growth, while still good, couldn't justify those extreme valuations, and the stocks came back down to earth significantly. It proved valuation always matters.
Okay, and then more recently, Malkiel touches on things like the biotech boom in the 80s and, of course, the dot-com bubble of the late 90s. Same patterns.
Very much so. With biotech, you had companies with no earnings, sometimes not even products yet, valued at astronomical levels based on, like, potential drug discoveries. They even invented new valuation metrics like product asset valuation, which was highly speculative.
Sounds like trying to justify the prices after the fact.
Pretty much. And the internet bubble. I mean, companies like broadcast.com being bought for billions with hardly any revenue. It was pure castle-in-the-air thinking, driven by the narrative, the fear of missing out, the belief that this time it's different.
It does feel like these cycles just keep happening. Malkiel also makes a crucial point about growth industries, even the revolutionary ones.
Yeah, that even the most dynamic industries eventually mature. Their growth slows down. Think about railroads, cars, electricity, even personal computers. They were world-changing, but their explosive growth phase didn't last forever.
Why is that important for an investor to remember?
Because it helps you maintain perspective. You shouldn't pay prices for mature companies that assume they'll keep growing at their initial rapid pace indefinitely. Understanding that life cycle is key to valuation.
Good point. He also quickly clarifies something about stock dividends. What's the deal there? Are they actually valuable?
Not really, in the way people might think. A stock dividend just means the company gives you more shares, but it simultaneously reduces the value per share. If you own 100 shares worth $10 each, and they do a 2-for-1 split, you now have 200 shares worth $5 each.
So your total value stays the same, it's just divided differently.
Exactly. It doesn't create any real economic value for you. It's more cosmetic.
Okay, so all these bubbles, the difficulty in valuing even good companies, the maturation of industries, it all seems to point back to how incredibly hard it is to actually forecast the future, right? Which is the bedrock of that firm foundation theory.
That's a central theme. Predicting future earnings, future dividends, future economic conditions, and how investors will react psychologically.
Yeah.
It's just immensely challenging. Investor sentiment swings between wild optimism and deep pessimism.
Like trying to predict the madness of people, as Newton said.
Pretty much. Malkiel uses an example trying to calculate IBM's intrinsic value at one point, showing how wildly different the results can be depending on your assumptions about growth and discount rates. There's huge uncertainty.
But he does offer maybe one practical shortcut, or at least a rule of thumb, using the price-earnings ratio, the PE ratio, relative to growth.
Yes, it's a kind of sanity check. He suggests that generally a company's PE ratio shouldn't be drastically higher than its expected growth rate. So if a company is expected to grow earnings at, say, 15% per year, a PE ratio of like 50 might be a red flag. It suggests the market is expecting way more growth than seems reasonable, or that growth will last for an incredibly long time. Conversely, a PE below the growth rate might indicate it's potentially undervalued.
So it's not a magic formula, but a way to compare the price you're paying to the growth you're supposedly getting.
Exactly. A practical guidepost for assessing if the market's castle-in-the-air expectations seem plausible relative to the potential firm foundation.
Okay, so wrapping up this first part of our look at a random walk down Wall Street, what are the big takeaways so far?
I think the main thing is this constant tension, this interplay between the logical fundamental value of a company to the firm foundation and the often emotional, psychological swings of the market, the castles in the air.
Right. You need to understand both forces.
You do. Understanding the basics of valuation is crucial. But so is recognizing that markets can be driven by narratives, by fear and greed, leading to these bubbles and crashes Malkiel documents so well. Being aware of that history can hopefully help you avoid getting swept up in the next frenzy.
It's definitely a call for combining analysis with a healthy dose of maybe skepticism and humility. So, as we finish this Book Talk finance segment, maybe one last thought for you, the listener, to chew on.
Yeah, perhaps think about your own investment approach or how you react to market news. Are your decisions driven more by trying to assess that underlying firm foundation value? Or are you sometimes swayed by the market's mood, the story, the castle in the air, maybe that fear of missing out?
Knowing yourself as an investor seems key.
It really is. Understanding your own psychology is probably just as important as understanding market mechanics.
Excellent point. Well, thanks for walking us through these foundational ideas. And thanks to all of you for tuning in. If you found this useful, definitely subscribe to the channel. We'll have more discussions and book talks diving into finance topics.
Look forward to continuing the discussion.